Ladies and gentlemen, I'd like to welcome back on stage Mike Butcher, Editor-at-Large at TechCrunch UK, who will be interviewing Ilya Kirnos, who's a CTO of SignalFire. So this is going to be a brilliant, wonderful session. Please do have your questions ready. We're going to try to make it interactive as well. So while the gentlemen get their mics ready, please do give them a very warm welcome. Thank you very much.
We're going to get into the weeds of building VCs these days, and also we've got a little group here. I mean, come on, we could do some Q&A. We could do some Q&A.
We could do some Q&A. Sure.
Who knows? Why not?
Sounds good.
My name is Mike Butcher. I'm a journalist with TechCrunch, one of the editors, and we have here Ilya from SignalFire. Now, for those of you who aren't aware, SignalFire is an interesting new VC, well, not new VC, but definitely taking a pretty new approach. I think that we're all familiar with the venture capitalists from the last sort of 15, 20 years. But let's sort of cast our minds back. How do you think VCs approached? Let's start from first principles. What's the sort of traditional approach for venture capital investing? Going to conferences and shaking hands with the founders?
Something like that. I mean, if you think about the startups that we invest in, they are all using cutting-edge technology to disrupt their respective sector or vertical. And yet VCs themselves traditionally have been very tech deficient. And when we started 10 years ago, that seemed deeply ironic and crazy to us. We thought that you could apply data and software to venture capital just like other startups are applying it to their respective verticals. And that really was my point of intersection with VC. I had been a software engineer, had worked at Google for many years, for about 9 years, worked on a bunch of different things there, ads, Gmail, et cetera. And when we co-founded SignalFire, we thought there was room to apply all the tools that Google used in their business to venture capital. And that really was how I came into venture capital. I'm still the CTO of our firm. We have a team of data scientists and engineers that work on a data platform that helps us make better investment decisions and also helps our portfolio companies, after we invest, with their biggest pain points, things like recruiting, go-to-market, so on and so forth.
I mean, generative AI, for instance, has become obviously a huge story in the last, well, I think probably toward the end of last year was when the early signals,
for sure.
Forgive the joke, came through, because people suddenly started to realize what OpenAI might be capable of.
Yes.
The rumor, of course, is that Google had this technology years ago with DeepMind, but never released it because they were quite scared about what was going on.
That's right.
But OpenAI, in their wisdom, shall we say, and Sam Altman decided to press the button. But I mean, certainly as a journalist, I think I've been pitched thousands of times by so-called AI-driven startups for probably the last 10 years.
Yeah.
In particular, I would say just before the pandemic, sort of 2018, 19, 17, 18, 19, those 3 years, just before the pandemic, there was a lot of talk about AI, but really with these companies were machine learning companies, weren't they? So what do you think is the qualitative difference now in the last year?
Yeah. I mean, if you think about kind of from a technology perspective, what's happened is, deep learning has been around for a long time. Neural nets go all the way back, kind of the theoretical principles go all the way back to like the 1950s or something like that. And they didn't work for a long time. And all of a sudden in the 2010s or so, they began to show promising results really as a result of a couple of developments. One was the availability of much more powerful hardware, specifically GPUs that could do lots of operations in parallel, and also the availability of lots of training data. And of course, there were some algorithmic advancements as well, but those were really the two drivers. And initially it was all around image recognition. So if you remember ImageNet, that was kind of like the first result that made a splash. then these neural nets were applied to translation tasks. So translating from French into English or something like that really moved the needle on performance and machine translation. And then what has caused the latest sort of bout of excitement is an application of deep learning to what's called language modeling. And really what that's all about is you basically have a model that you train to predict the next word in a sentence, roughly speaking, right? So you have Alice in, what's the next word? Well, Wonderland with 80% probability, let's say. Alice in New York, 5% probability, something like that. And it turned out that these models had surprising properties. You know, something that's so simple to define turned out to have these emergent properties that people didn't expect, such as being able to chat with people in a very human-like fashion, or being able to ostensibly answer search queries, much like a search engine would. And of course, they have their problems with hallucinations, et cetera, but that's kind of what kicked off this latest cycle of excitement, these sort of emergent properties that people didn't really expect.
Right, yeah, and it is completely transformative, isn't it? And we only seem to be sort of touching the surface of what it was. But I think it's worth impressing upon everybody the kind of talent we've got here on stage, because Ilya, you were a software engineer and at Google. You worked on Google AdWords. You worked on Google's analytics products. So I mean, the fact that you're a partner at a VC, you still really retain the CTO title, do you?
Yes.
Don't you?
Yes.
And I'm sure that, you know, both professionally and personally, still very interested in deep in the subjects around the engineering side of these things. Do you think that, let's sort of take a skeptical view for a second and say that a lot of the things that we know about startups and the way they behave, it isn't necessarily really about training models around data. So for instance, you can take a team and you can say maybe they're all Stanford graduates or whatever, but that doesn't necessarily predict success in the same way that you might get a large language model to predict the next word in a sentence.
For sure.
And so it's a different kind of thing. You're dealing with human beings, aren't you? They have personal lives. Some of them are married, some of them are not married.
Yep.
Some of them are going through divorce, some of them are having kids, or some of them have just graduated, and some of them are just coming out of rehab, or God knows what's going on with them. So they're all different.
Yes.
So how you apply AI to investing isn't really as obvious as it might seem, surely.
Yeah. So look, I mean, for sure, it's not like we have a black box trading algorithm that says, here's the next Facebook, go give them a term sheet. But there are factors that correlate with and predict success, and what those are depends on the field and the area. For example, in consumer, if you look at successful consumer companies, it would have been very difficult to pick out those founding teams out of the field. You know, so you have college dropouts, you have people who are coming from different areas, not necessarily deep technical experts in anything, that happen to capture that novel consumer behavior that leads to success. And that's really hard to predict. And there, I think, in sort of what you'd look for is early traction signal, right? So if you think about kind of early Twitter, for example, started out as a podcasting app, failed, kind of a last-ditch pivot into what became Twitter, and it worked. And I think even they were surprised that it worked as well as it did. And so that would have been really hard to predict based on kind of initial team. But as they got traction, as they got visits to the website, as they got app downloads, as some of those metrics became evident early on, that is something you could have captured. And you didn't need to predict it. You could have just sort of looked at it real time. So if you had that data, you would have been able to say, there is something interesting going on here. And then you still have to do venture. You still would meet with the team, and there's no substitute for sitting across the table from an entrepreneur, understanding their vision, how capable are they in terms of being able to sell to customers, hire, raise money, all those things. So for sure, it's a human in the loop problem. The data is an input into the human decision making, and it allows you to have almost like an army of digital associates that are attending every conference in the world, talking to every company, and bubbling up the ones that have the most promising signals.
I see. So there is a way of doing it to some extent, but of course it doesn't replace that human element
For sure.
that still VCs need to do. If you're looking, obviously you're here, and I know one of your colleagues is coming as well from SignalFire here to GiantX. There must be a reason you're here. Perhaps you're looking for LPs, but also looking for, perhaps interested in the companies here. I'm not going to throw you in the deep end and ask about what companies you're interested in. But what I think more generally, what people might be interested in hearing is what signals, what things are you looking for in companies here that might be similar to the Valley or the US, or different perhaps?
I mean, for sure. I mean, we love deeply technical companies, deeply technical founders, and so that would be the same. That would be very similar. If you have great technical talent, that's always a company that we'd love to talk to. And one thing that's happened in our investing is before COVID hit, we were certainly much more US-centric, and in fact, probably more California-centric. My firm is based in San Francisco, and so probably 80% of our companies were in Silicon Valley in the Bay Area. After COVID, it sort of became irrelevant where you were based. We were all living kind of in Zoomlandia, and we opened up our aperture and invested in much more global companies. We have investments that we've made in Europe and India, none in Dubai so far, but because of that kind of more broad aperture, we want to explore some of these new regions because technical talent's everywhere these days, and the world's become much more connected, much more global.
Right, yeah, so, and we're all very familiar with the fact that there's some pretty amazing technical talent in MENA, generally speaking. NVIDIA has outsourcing here in the Middle East. Microsoft has outsourcing and engineering, even R&D in many of the countries in this region as well. So there's that going on. Just give us a little bit more about SignalFire itself. Well, how much have you gone under management? What kinds of companies could you talk about that have come to mind when you talk about the typical kinds of companies you've invested in your portfolio? Just give us a little bit more of a kind of a rundown on it.
For sure. So we have a couple of billion under management. Our current fund that we're investing out of is 900 million. And you can think of it roughly as a third, a third, a third. A third is allocated towards seed stage investing, which for us means check sizes anywhere maybe from 1 million at the low end to maybe 7 at the high end, when the sweet spot being 3 to 5. And then a third of the capital is allocated toward later stage investing, which in our case means sort of Series B, Series C. And then we have another fund that's our executive in residence fund, where we pair our investment with an executive going into a company, so more hands-on approach. And from a sector perspective, we're generalists. We've invested in lots of consumer companies. These days, we're more enterprise focused just because of the cycles and consumer investing. But historically, we've had plenty of consumer investments in companies like Grammarly, which is later stage, maybe better known now, and companies like Uber. These days, where I'm spending most of my time is on the infrastructure side in AI/ML, just because of my background, looking at lots of applied data companies, data infrastructure companies, AI/ML.
Right, yeah. And so you've obviously got a big fund, you've got a lot of companies under management. Let's sort of zoom out right now and just look at where we are in the cycle, because there's obviously the last couple of years were pretty frothy because of the post-pandemic boom, and then crypto went completely nuts. There was and now of course totally completely corrected, and of course the wider macro economy isn't very favourable to things in tech right now. There's very few IPOs. So the exit markets are quite blocked at the moment. Perhaps some M&A in the next few months, perhaps into next year. What are your thoughts about where we are in the cycle, and is it 2008 all over again, or is it different?
I know there's a lot of doom and gloom, but I guess from where I sit, it's not that bad. I'd say it's maybe bad compared to 21, when let's be honest, there was a bubble. We went through sort of a period of irrational exuberance. And now things have corrected to maybe where they were, I don't know, 5, 6, 7 years ago, something like that. Sort of back to long-time averages. If you look at sort of multiples on revenue, some of these valuation metrics, things aren't that bad, at least sort of in kind of the area where I'm familiar with kind of US kind of based investing. And I think what happened was as the public markets corrected, the private markets took time to adjust and react to the shrinking valuations in the public markets. And there was a pause, a lull, as companies sort of came to grips with this new reality. And it's really, the seed market never stopped. It was always very active, even through 21, 22, and this year. It was really the growth market. I would say Series A, Series B plus kind of financings that are more meaningful dollars. Call it, 20 million plus rounds, something like that, that really saw a meaningful slowdown. And those are coming back. Those are coming back now. We see it in our portfolio. And I think what's happened is there's been a reset in valuation expectations from founders, and now kind of everyone accepts that this is the new normal. Whereas before maybe people thought this was a temporary sort of lull and things would go back to the previous highs. And I think people have accepted this is the new normal, and great companies are still getting funded. If I look at our portfolio, there's been a lot of financing activity at that growth stage. 40 million plus rounds just in the last few months. So I feel like the market's kind of coming back for great companies. They have no trouble raising right now.
Yeah. So in a way, it's almost like at the seed stage, if you've got a decent company, decent team, you're going to be okay. If you've got that growth stage, you're already on your way. You're doing well. You've got traction, etc. It's the late stage companies that are going to find it harder, perhaps. The ones that were closest to IPO at the time and now are going to have to hang on for longer.
Yeah, I mean, the issue for them is they probably raised in the private markets at a much higher valuation than the public markets are willing to pay.
Yeah.
And I think you've seen that with some of the latest IPOs in the US, like Instacart. If you look at their latest private valuation, it was much, much higher than what the public markets are willing to pay. And that's the reality of that's why there's a slowdown right now. If you're a founder, CEO of one of these companies, if you can wait, you probably wait. Because the thinking is, well, I've got plenty of cash. I don't need to sort of take this repricing right now. Maybe I can grow into my last round valuation. And so that's why you've seen that slowdown at those later stages.
Yeah, exactly. But yeah, this early stage is still plenty of talent and plenty of great companies to get. And to hark back to what we were talking about earlier in terms of generative AI.
Yeah.
What's so interesting? I mean, you can put a large language model on a thumb drive, isn't it? Can't you? And it's absolutely incredibly. I mean,
you could probably store it on a thumb drive. You probably couldn't serve it off a thumb drive.
You can't run it off a thumb drive. Yes, you could store it on a thumb drive. I guess some thumb drives are pretty big now, aren't they? But it is so interesting, isn't it? And I think you would probably agree with me if you said that because it's so generative AI, large language models, learning models, especially in the open source world, are so interesting, so distributable, that the whole world is going to benefit from these things. And it doesn't matter if you're in Dubai or Riyadh or Cairo or San Francisco, that you can still play with this technology.
Yep. And I think what you're seeing right now is kind of the search for the killer app of this technology. If you think back to maybe, 9 months ago, whatever it was, maybe almost a year ago now, when ChatGPT was first released, I think most people sort of immediately thought search was going to be the killer app. If you remember, Google's stock tanked. Bing rolled out generative search very quickly, and there was a lot of buzz and a lot of hope that kind of after so many years of Google dominance, this market was going to be able to get cracked open and new entrants were going to be able to come in. I think to a large extent those hopes haven't been justified. If you look at Bing's numbers, I don't think they've taken meaningful market share from Google in search. But that's what's happening. I think there are going to be false starts as people search for applications of this technology. But then you have companies that are doing amazingly well. So if you look at things like GitHub Copilot, right? So code generation. They just announced they surpassed 100 million of ARR. That could be just a standalone company on its own. Amazing growth. And so that seems certainly like one of the killer apps of this technology. And there are going to be a ton more, and lots of companies are raising a lot of money right now to go find those killer apps. Many will fail, but some will succeed and lead to big outcomes for sure.
I mean, if we'd been doing this 2 years ago, we would have been sitting here talking about Web3.
Yes, we would.
And that you know, and I mean, I've interviewed the founders of Ethereum. I've interviewed lots of interesting people in blockchain space. Some, you know, certainly on the exchange side of things as well. And with, you know, Sam Bankman-Fried, you know, in court, all sorts of, you know, really the crypto market halved or, you know, decimated really in the last sort of year, 6 months really, certainly in the last year. Where do you have any views? I'm not sure if you're a specialist in this, but do you have any general views on the prospects for breakout technologies emerging from, let's just call it blockchains at the moment, or, you know, are you still optimistic about the platforms themselves?
I would say I'm still pessimistic. So SignalFire was never heavily investing in crypto. I sort of personally would separate crypto in maybe into two different segments. I would say there's Bitcoin, and then there's Web3, right? If you look at Bitcoin, what is Bitcoin? I think the killer application of Bitcoin is a store of wealth. It's digital gold, and you know, we can argue whether gold should have a place or not, but the reality is it's been around for thousands of years. It's got product market fit as a store of wealth, right? And so Bitcoin in many ways has advantages over gold, like portability, like the ability to store it securely. You don't need a vault or whatever. And so that, I think, you know, the price of Bitcoin has held up relatively well. And I think it kind of shows you that there is some product market fit in that part of crypto. The Web3 part of crypto, which is sort of what I would describe as kind of application platforms like Ethereum, like Solana, et cetera, they went through their experimentation phase, and there was an explosion of companies trying to build applications on these things. And I would say the results have come back fairly negative. I mean, I can't think of a huge application that's taken off on these platforms that has millions of users using it every day. There were sort of flashes of gaming or whatever it might be, but those were temporary and sort of have receded. And I think that's kind of what, to me, is kind of the existential crisis of that sector is, what are the killer apps that are going to be developed on these platforms? I don't see them yet.
So you're skeptical about, for instance, in fintech. So a lot of Web3 applications took off in the area of fintech, so banking the unbanked,
like lending, et cetera. Yep.
Yeah, assets, tracking assets, for instance, as well.
Yep.
You don't think that there's further applications in that?
You know, I guess my biggest question there is, why do you need blockchain? You know, at the end of the day, a lot of these enterprise blockchain use cases, my question was always, a blockchain is just a distributed database at the end of the day. And you know, in the case of a Bitcoin, you know why you need it. You can't trust third parties, right? Because of double spend, because of fraud, et cetera. So you need kind of that proof of work on top of this blockchain. In enterprise, when you have a bunch of companies that can basically sign contracts and legally enforce them, there's ways to enforce trust via long-established mechanisms that frankly don't need all the overhead of a blockchain database. I mean, a blockchain database is literally hundreds of thousands times less efficient than a centralized traditional database. So in order to be able to kind of like pay that overhead, you better have some killer features that are truly needed for your application. And
you haven't
seen those.
You didn't think smart contracts had legs?
Well, you tell me. I mean, where are they being used? I haven't seen it.
Well, I mean, there was a lot of hype. But,
there was a lot of hype.
Yeah.
And, you know, these things always go like this. There's a lot of hype around AI right now. I think maybe to me the difference is already there have been more useful proof points of more useful applications. Just like, you know, GitHub Copilot alone, I would say has brought more end value to users than maybe all of crypto combined so far.
Right. Yeah. Well, I mean, I suppose it would be fairly easy to answer the question then. Will it be easier to do the due diligence and kick the tires on an AI-driven startup versus a Web3 startup?
I think they actually have some things in common where lots of Web3 companies were also very technical. If you're developing a new protocol, like a layer 1 protocol or et cetera, you better have a great technical team. The same is true in AI. I think the advantage we have as practitioners and builders in the field, that we're using a lot of these tools, we're building on top of them and using them every day, is it's easier for us to kind of get under the hood, go deep with the teams and understand, are they capable of building what they claim to be building? Is it going to be useful? Kind of separate the hype from reality. And so they share some of that in common, but I'd say with AI, you see a lot more kind of believable end use cases that are like, it's more like, if you build it, if this thing that you are saying you can build can be built, it definitely is valuable. Because there is a pain point there that is obvious and can be solved, if it can be solved.
Yeah.
So I'd say, there are some commonalities and there are some differences as well.
Going back to SignalFire, your firm, you have, you were definitely one of the first VCs I'd ever heard of that was going to try and use AI and certainly data-driven approach to investing. Certainly one of the first I'd ever heard of in the Valley. Is there going to be a point at which this is going to become difficult to compete? Because wouldn't it be the case, though, that other firms and other VCs are using similar kinds of approaches? They clearly, I think they're clearly going to wake up to the fact that they should be doing this kind of thing themselves. How do you think investors are going to be able to differentiate themselves? Is it going to be the investing team?
Yeah.
Is it going to be the kinds of portfolio companies that they've already backed? What are the kinds of things that, if you're a founder and you were looking and you had 10 VCs to go with and they were all using AI, how would you pick?
Yeah, it's a great question. Our take on this, lots of our LPs and prospective LPs obviously ask us this question before investing in the fund. And when we started out 10 years ago, it was very controversial to say that you would be using data and AI in venture capital. Because, I think the prevalent view back then was this is an art, not a science. And by the way, what data even exists at the early stage? Because oftentimes you just have a founding team and an idea and not much else. Our answer to that was, well, the answer is in the question. There's always a team to start with, right? So understanding talent is a big, important signal. And then if you fast forward 10 years, in the US, it's actually flipped 180 degrees. I think if you don't claim to be using data as a venture capitalist now, you seem antiquated and out of touch. And what I would say is the differentiation and where it comes in is the depth and the degree to which you use data. Most VCs kind of dip their toe in the water and maybe hire a data scientist. Our experience has been that this is a really difficult technical challenge, and you really need a serious engineering team, a data engineering team, as well as a data science team to do this right. And you need lots of investment.
It's not something you can sort of outsource.
Lots of VCs do. They outsource this to teams in China or maybe Eastern Europe, something like that. And our experience is you can't do that. This is a really hardcore engineering challenge. And lots of VCs say they're using data, and there's a spectrum. If you're using a CRM to log your meetings and compare notes, are you using data? Yes, you are in some ways, but that's a spectrum. We take it all the way, right? We have our own in-house engineering team, our in-house data science team. We buy raw data, and we ingest public raw data, much like a mini Google. So we built kind of a mini Google in-house. And that's what separates us from other VCs who are maybe dabbling in this space and saying they're data-driven, but the reality is they're using data in ways that doesn't really give them an edge in the market, in our experience. Again, in our experience, it's a really hard thing to be able to do. If you're a successful existing venture capital firm, you have kind of the innovator's dilemma. You've been successful doing it the traditional way, and you have to make a huge investment in doing it this new way, which may take years, and the partners who are starting that effort may not even be at the firm to see the results. And so it's kind of, the reason that an Uber or a Careem didn't start inside a taxi dispatch company, right? They just don't think the same way.
Yeah, and we are living through a very interesting time, aren't we? There's in terms of looking at AI, the rumors are that in the published media, as far as we know, people like Sam Altman and Johnny Ives from ex-Apple are looking at a hardware device that might have an AI on it. So who knows, in a couple of years' time, we might be walking around with, I don't know, something stuck in our ear or something over our glasses that will be assisting us.
Yeah.
I mean, let's have a little bit of a science fiction moment, and let's think about, what do you think life is going to be like in a few years' time? Will we be living very differently? I mean, if we were to cast our mind back, say, 20 or 30 years, people talked about, you know, we got 160 characters, but we didn't get a flying car. Well, we're getting flying cars now, gradually, aren't we? What sort of... Do we think that we're going to be having a very much more of a sort of a Blade Runner style existence, or what do you think?
Yeah, it's a fun question to think about. I mean, in many ways, so I think a big open question right now is, how far will the scaling of these LLMs take us? Right? Because, you know, in some ways, you know, I'm of an age where my first computer was a 286 PC. In the late 80s.
Right.
And if you remember those days,
What was that? What brand was it?
Gateway 2000.
Gateway 2000.
With a cow pattern on it.
You had the Mercedes.
And what was happening in those years is, you know, Intel would come out with a 286, right? And then invest $10 billion, build a fab, and in 2 years you would get the 386. That was twice as fast, twice as cheap. And then $10 billion, and 2 years later, you'd get the 486. Again, twice as fast, twice as cheap. Moore's Law, right? The Pentium then came out, et cetera. And if you were buying the 286, could you have predicted all the applications that would exist in 10 years once the Pentium came out? There was a huge explosion of everything from video games that were just unbelievably realistic compared to what people were playing character-based games on the 286. All the way to productivity software, all the way to computer-aided design, right? And so I feel like we're sort of in that stage with, if you think about the advent of PC as maybe democratizing computation, maybe LLMs are the beginning of democratizing intelligence, if these scaling laws continue. And it's a bit of an open question whether they will or not, but if they do, I think we might be taking a run at something that's close to sort of artificial intelligence, as people think of it, kind of like human-like artificial intelligence, in not too many years. So a lot between here and there, but you know, that could be a future we're looking at. And then you have these things running inside your phones for sure, and I'm sure efforts are underway to make that happen. And then you have them, maybe domain-specific ones that are maybe smaller, require less compute, in maybe your microphone to make your voice sound better or whatever it might be, or pipe questions into your ear, or maybe I'm not talking to you, maybe you're an avatar now. So all those things could happen.
I'm coming to you live from London. I don't know if that was the music. It was a hit to us, but I think. The one thing, I suppose, the last thing we could sort of speculate on is the idea that, I mean, let me ask you this final question. You mentioned the 286 and then the 386, and it did take 2 or 3 years for these things to come out. But surely we're living now through a period where it's not Moore's Law in the sense, you know, things get twice as fast in 2 years' time. They get exponentially faster, like in 6 months or something. I mean, the difference between ChatGPT 3 last year and ChatGPT 4 now is quite different, isn't it? It's not a sort of a 2-year cycle.
Yeah, that's the open question. Nobody quite knows how fast these things can progress and how long it'll take to get GPT-5. The rumor is next year is when it's coming out, so maybe on a yearly cadence, something like that. Now, Sam Altman has said that, you know, he will need to raise $100 billion to get to where they need to go. They'll be the most capitalized startup in Silicon Valley history. From that perspective, it's very similar to semiconductors, where it was extremely capital intensive to build these things. And LLMs seem like they're on track to be similarly capital intensive. And you'll see only a few companies being able to raise that kind of capital. You're seeing it now. You have OpenAI pairing up with Microsoft. You have Anthropic pairing up with both Google and Amazon. Taking investments from them, Cohere taking money from Google, and that's the reason is, you know, that kind of money is too much even for VCs. You're talking about corporate strategics now and sovereign wealth funds at that level. So from that perspective, it's actually similar to semiconductors.
Yeah.
Now, as far as timeline is concerned, I think it's more elusive. It's harder to predict because back then, it was more of a physical limitation. We just need to shrink this thing down so we can fit more transistors, and people kind of knew how to do that. Here, it's a little bit still more of an art than a science, and so the progress of these things is a little bit more difficult to predict, but lots of smart people believe that they will continue to scale, and so that's a possible future.
Right, yeah. Well, it's a future that we're definitely, you know, assuming we're around in the next 6 months or a year, we'll be living through it. Certainly, the takeaway is we should all have invested in NVIDIA and GPUs a million years ago because the chip makers are going to win, aren't they?
Yep.
Anyway, ladies and gentlemen, I want to please give a big round of applause for Ilya Kirnos, for partner venture of CTO from SignalFire, and Mike Butcher, your host today. Myself, I'll be back at here on the stage in a couple of days, but mostly at GITEX, so I'll see you at GITEX. Thanks very much.
Thank you, Mike.